Good morning and welcome to Capital Sound. The big question today, if there's smoke in the hallway, why does the market look like it's selling fire insurance? Pre-market feels calm after a Hormuz shock headline. Ooh, are we misreading the risk? I'm Mandy Prince, and with me today is Bradley Ashford.
Morning, Mandy. Great to be here.
Quick snapshot before we dive in. Futures are mostly steady to slightly softer. Volatility looks calm for now, and leadership is mixed with energy acting firmer, while growth feels uneven. Ooh. Yields are nudging a bit higher, nothing dramatic on the surface. Those are the numbers. The real question is what's underneath.
I'll be blunt. The calm is the danger. This looks like a rally sitting on a lit fuse. The catalyst I care about is a concrete shipping blockade headline. If that firms up, it forces a repricing of risk across equities and credit. The market is behaving as if this is just noise, but the energy shock is already tightening the punch bowl.
That's a strong opening. Most people would say stocks are up, oil spikes come and go. Why do you think the equity rally is the wrong read and oil is the real signal?
Because oil near 100 reopens the inflation channel at exactly the wrong time. That's not sentiment, it's math. Higher energy costs squeeze margins, hit consumers, and tighten financial conditions. The trigger that changes behavior is an energy price shock that sticks, not a quick headline pop. If that happens, the market has to reprice risk premia, and that shows up in credit before it shows up in stocks.
Hold on, risk premia is jargon. Translate.
In plain language, investors demand more compensation for taking risk. When the cost of doing business rises, you want a bigger cushion. That means less generous valuations and tighter lending.
Okay, but the market's rallying off a 3.5% jump recently. Doesn't that signal confidence that this is contained?
I actually think that move makes the setup more fragile. What would force a re-rating is a shift from this will pass to this will linger. When markets rally, conditions loosen, easier financing, more risk-taking. But an energy shock can reverse that fast. That's the contradiction. Risk-taking is rising while the macro headwind is strengthening.
Let's press on the clash. You're saying oil is the signal, not stocks. But could this just be about positioning, not fundamentals?
Positioning matters, but fundamentals are the base case. The catalyst is not just price, it's persistence. If energy stays elevated, central banks get nervous about inflation and credit spreads widen. That's the link. We saw a version of this in 2022. Rates shocked higher and suddenly equity multiples compressed. That wasn't about narratives. It was about the cost of capital.
That's helpful. So take me through the mechanism. How exactly does an energy shock tighten financial conditions even if stocks are still rallying?
Two channels. First, inflation. Higher energy feeds into prices, which pressures central banks to stay tighter. That makes borrowing more expensive. Second, cash flow. Companies spend more on inputs, consumers have less discretionary income, and credit quality comes into question. What unlocks the downside is when lenders start asking for higher yields, which then ripples into equity valuations.
You're essentially saying the market is partying while the punch bowl is already getting pulled.
Exactly. I'd phrase it this way. It feels like selling fire insurance while smoke is already in the hallway. That's why I'm skeptical of the calm.
That line is going to stick, but let's test you. If stocks are reading geopolitical risk as manageable, why are you so convinced that's wrong? Is this just a macro worry, or are you seeing something specific?
It's specific. The trigger I'm watching is a concrete disruption at the choke point. A single, confirmed blockade headline can force a risk reset. That's not an opinion, it's how systematic strategies react. The market is priced as if that's unlikely, but the cost of being wrong is huge.
Okay, now we're getting into mechanical risk. You mentioned systematic strategies. That's where I want to go next. Is the real risk not the oil itself, but the mechanics? Short vol exposure, short gamma. Those phrases are scary. Translate for listeners.
Right. Short vol means people are positioned for calm. They profit if markets stay quiet. Short gamma means when prices move, they have to sell into weakness and buy into strength. It can amplify moves. If a headline breaks, those strategies can all de-risk at once. The catalyst is that single headline that forces them to unwind.
So you're saying the market plumbing could turn a small spark into a big move?
Precisely, and that's why I don't dismiss headline risk. It's not just about oil fundamentals, it's about forced selling. One concrete blockade headline can make equities, crypto, and rates gap together as those strategies rebalance. That's the mechanical risk.
Wait, gap together in plain English? You mean everything moves down at the same time?
Correct. Correlations rise. When everyone de-risks together, diversification stops working for a moment.
That's honestly a little scary. Let me challenge you though. If this is true, why hasn't it happened already? We've had plenty of headlines.
Because markets can be complacent until they aren't. The catalyst needs to be concrete and persistent. A headline that actually impacts shipping or insurance costs, that's the trigger. It's the difference between talk and action.
I want to pull us back to the business lens. You're an activist investor. How does your framework show up in a macro-heavy conversation like this?
I anchor on quality and catalysts even in macro. The competitive moat matters most when conditions tighten. High free cash flow businesses can absorb shocks, but the catalyst still matters. Management's response to a cost squeeze, capital allocation choices, pricing power. Those are the levers that protect ROIC when macro turns.
So for listeners, when Bradley says free cash flow, he means companies that generate cash after expenses and investment, the ones that can keep funding themselves even if credit gets tight.
Exactly. And the catalyst is whether management adjusts behavior, cutting non-essential spend, prioritizing returns, protecting margins. That's what separates resilient from vulnerable.
Let's shift to the risk sentiment tell you flagged, crypto. We had a big infrastructure win, Kraken's Fed approval, and crypto still sold off. What does that say?
It tells you macro is dominating. The trigger for a crypto rebound would be a clear easing of macro risk, not just good industry news. Crypto is the purest sentiment barometer. It reacts quickly to risk appetite. When it can't rally on positive news, it's a sign the broader risk budget is tightening.
That's a compelling point. It's like a canary in the coal mine.
Exactly. And the catalyst for improvement there is clarity on the energy shock and financial conditions. Until that's resolved, idiosyncratic wins get drowned out.
I want to make sure we don't over-index on one narrative. Give me two paths from here. If this goes well, what's the favorable path? If it doesn't, what should listeners expect? And give us a signal to watch for each.
Scenario A, the favorable path. If the Hormuz headlines cool and energy prices settle, financial conditions can stay loose and risk appetite continues. The signal to watch is stability in energy markets and credit staying orderly. Scenario B, the risk path. If a concrete blockade headline emerges, you get a rapid risk reset, broader assets drop together and volatility jumps. The early warning sign is cross-asset correlations rising and a sudden pickup in implied volatility.
And which scenario do you think is more likely?
I lean toward the risk path, not because I want it to happen, but because the market is priced for calm and the catalyst for repricing is uncomfortably close. I'd need to see a clear de-escalation signal to change that view.
That's very clear. Let's bring in Tesla as a sentiment proxy. Why Tesla?
Tesla trades like a risk appetite gauge. It's a high-profile, high-beta stock. The trigger I look for is whether its tape holds up on a macro risk day. If it can't catch a bid, that usually signals broader risk aversion. If it does, it can stabilize sentiment.
For listeners, tape just means how the stock is trading day to day, the mood around it.
Right. And in activist terms, Tesla's business quality is debated, but as a sentiment proxy, it's a real-time poll. The catalyst for a positive shift would be evidence of margin stabilization or improved capital allocation discipline. Without that, it's mostly a risk-on barometer.
I want to inject a bit of human perspective. Have you seen a setup like this before?
Yes. The closest parallel for me is early 2022, when the market was pricing in calm while rates were about to shock higher. I initially underestimated how quickly financial conditions would tighten. That experience taught me to respect the linkage between energy and credit. The catalyst is the point where the market realizes the cost of capital is changing.
That honesty is useful for listeners. Let's get practical. What should a listener do with all this? Not in terms of trades, but mindset.
This is the kind of environment where patience beats speed. The catalyst matters more than the narrative. If you don't have a clear trigger for why something should re-rate, it's probably not the right time to take big risks.
I like that. Patience beats speed. It's not advice, it's a framework.
Exactly. And remember, quality businesses with clear catalyst outperform. That's the anchor.
we're in a contested episode, so let me push back once more. You're focused on energy as the trigger. What if this is just a headline cycle and oil fades? Doesn't that invalidate the whole thesis?
If energy cools and credit stays calm, I'll revise. The catalyst I'm watching is whether shipping disruptions translate into sustained cost increases. If that doesn't happen, the market is right to look through it. But right now, the asymmetry is on the downside. The market is priced for calm, not for a true disruption.
That's fair. I also want to call out a potential policy overhang. We have headlines, but markets tend to focus on earnings and data. We should keep that in perspective.
Agreed. Headline risk is real, but earnings and cash flow ultimately tell the truth. The catalyst from an activist perspective is always management action, the way companies respond under pressure.
Before we wrap, give me one takeaway. If listeners remember just one thing from this morning, what should it be?
If the smoke is already in the hallway, don't mistake quiet markets for safety. The catalyst that changes everything is a single concrete disruption that forces de-risking across assets.
That's crisp. Let's finish with a quick watch list. 3 things to watch into the open.
1. Crude's reaction to any concrete Hormuz headline. That's the macro trigger. 2. Cross-asset correlation and volatility. If those spike together, it signals a positioning unwind. 3. Tesla's trading behavior as a real-time read on risk sentiment.
Great. Thanks for listening to Capital Sound. We'll be back this evening with a full recap of how the day played out. Bradley, last word?
In this tape, the catalyst is the compass. Ignore it, and you're navigating blind.
Have a great trading day, and goodbye.